We are getting breaking headlines now from Morgan Stanley coming out.
Earnings per share at 47 cents. That's a little bit below estimates, which had it at 49.
Yeah, for the fourth quarter, net revenue coming in at $1.04 billion. Morgan Stanley says they are seeing fourth quarter. Well, yeah, it looks a little bit weaker. Essentially, it appears to be that the story, once again, is this weak trading revenue. For more, let's bring in Alison Williams from Bloomberg Intelligence. Alison, I know this is a bit unfair to do for you because you don't have the terminal right in front of you. But what does that look like to you? 47 cents earnings per share. Does that sort of fit the story we've seen from the big banks across the street?
Well, it looks like the operating number was lighter than that. 40 cents is what I'm saying. I'm not sure if that's
okay.
And keep in mind you want to X out valuation gains, and there's probably a legal charge. We've seen that at several of the banks this quarter.
Right.
I think for Morgan Stanley, for most of the banks, what we've seen is the fixed income coming in weaker than expected, equities better. For Morgan Stanley, they have sort of a unique commodities business. It tends to be a lot lumpier than some of the other companies. So if there's a big delta in the earnings, my guess is that's where I'd be looking.
And there was a revision down in December, right after they said that they were going to, change compensation to be more in line with other finance companies.
Well, they came out and said that they were going to be taking sort of an extra cost in the quarter. We're seeing that kind of, I think, come across now. They elevated compensation expense by $1.1 billion. They had said 1.2. And really what they're doing there is moving more from, I think they had said they were at 80% deferred on average for bonuses, and they're going to a 50% ratio. And what that really means is as you pay your employees more in cash today, your expenses are higher today, but what's helpful about that is it improves your flexibility in future years because you have less costs coming in future years when you take the cost today and defer less.
Where do you think we are sort of in the multi-billion-dollar fines? Are we finally in the ninth inning here?
For the U.S. banks, I think we're eighth or ninth inning. And if you look at what the investment banks, I think, are trying to do this quarter or in the next several weeks is really to try to accrue as much expense as they can into 2014 to really get that behind them. And they have sort of a few more weeks. We've been hoping to get some settlements and just to get some closure on some of those losses.
For years now, the story has been cost-cutting and cost-cutting, but a lot of people are telling us now that basically all James Gorman and Jamie Dimon can do is cut into bone. Is there any more fat to take out here, or perhaps are we going to see job losses?
I think as long as you see revenue pressure, you're going to see a focus on costs. It's just the way that the math is going to work. And I think you can't look broadly. I think you have to look at individual businesses and what's happening. So in certain businesses, you may be starting to get close to cutting into bone. But in other businesses where there is still opportunity for technology to improve efficiency, perhaps there's more opportunity to bring the cost down.
When you look at the overall, the weak trading we've seen for the fourth quarter overall for all the big banks, do you think that this is a direct result of Dodd-Frank regulation?
Well, I think there are some things that are a direct result of Dodd-Frank regulation, right? So we have banks that have scaled back from certain businesses, and the bigger impact has really been on the overall profitability of the firm. So banks hold more capital. Your return on that capital just mathematically is going to decline.